Hello class. Today we're going to talk about bonds, their valuation and interest rates. And from time value of money, you already know the value of a bond is the present value of all future cash flows. So I hope that you'll have easier time in this chapter because you spend a lot of time in understanding time value of money chapter. So let's start. In this chapter, basically, we're gonna talk about the following topics. Okay, so bonds and their valuation, bond yield, the relationship between bond price and yield, risk in investing on bond, government and corporate bonds, inflation and interest rates, the term structure of interest rates, and finally, we're gonna talk about the determinants of bond yields. At the end of this class, you'll be able to know the important bond features and their types. You'll know how to compute bond values, yield to maturity, yield to call, coupon rate. You'll be able to explain the relationship between bond yield to maturity and bond price. In other words, the relationship between interest rate and bond price. You'll understand the impact of inflation on interest rates. You'll understand the time structure of interest rates and the determinants of bond yields, and finally you'll know the effects of bond ratings on bond price. Okay, so let's start with the definition of a bond. So what is a bond? Probably you have invested in stocks. Maybe some of you have invested in bond. So if that's the case, it's not difficult for you to explain what is a bond, but let's assume that you don't know what is a bond. Okay, so a bond is basically a debt instrument. Okay, so company raise capital from different sources. So one of them is bond. So when they need money, companies or government, they need money, they issue bond. So bond is a debt instrument. It is a long-term debt instrument in which a borrower agrees to make payments of principal and interest on a specific dates to the holder of the bond. Okay, so if you invest in a bond, you're gonna receive interest, and at the end of the maturity, you'll receive your face value plus the last coupon. Okay, so bonds are also called fixed income securities. So what is the difference between bond and stocks? Okay, this is a really important topic. Okay, so let's talk about the difference between stocks and bond. Actually, I would like you to watch this small video clip so that you'll be able to understand the difference between bond and stocks.
Most people are much more familiar with stocks than bonds, yet the value of U.S. stocks and bonds are almost equal. Bonds just don't attract as much attention because the stories behind stocks are easier to follow. Compared to stocks, bonds rarely make news. A bond is basically a loan, or rather the long-term debt of the issuer. The issuer promises to return the face amount, or par value, at maturity. Typically, the issuer is also liable for regular interest payments. Bonds are the most senior debt and are the first debt repaid in case of bankruptcy. Conversely, a share of stock represents an equity, or ownership right in a corporation, as well as a share of the corporation's earnings. Stocks have the least seniority and are the last to be paid if the business fails. The South Beach hotel developer recently issued $83 million worth of bonds to finance the hotel construction. The hotel developer issued the bonds in standard $1,000 denominations, which will mature in 6 years when the developer plans to sell or refinance the hotel. The bondholder will be paid interest, known as coupon payments, each year for 5 years, and in the 6th year, both interest and principal will be paid. The hotel developer gets a tax deduction for the interest expense and a better interest rate than they would on a loan through a bank.
Now let's talk about the different types of bond and the issuers. Okay, uh, broadly speaking, there are two types of bonds: government bonds and corporate bonds. Okay, government bonds, they are two types: treasury bonds and municipal bonds. So treasury bonds are issued by federal government, and municipal bonds, which are also called munis, are issued by state and local governments. And corporate bonds are issued by corporation. And here I have just another category here, foreign bonds. So basically foreign bonds are issued by foreign governments or foreign corporations. So basically the foreign bonds actually go under government bonds and the corporate bonds. Okay, so we have two broader category of bonds. This is an example of a bond. When a corporation wants to borrow some money, it often sells a bond. Okay, and investors gives the firm cash for the bond, and firm promises to give the investor interest and face value at the end of the maturity. Okay, so face value is basically principal amount of the bond repaid at maturity. In other words, it's a future value. Okay, and coupon payment is basically, coupon is the stated rate interest payments made on the bond. Okay, so the coupon rate is the annual interest, rate of interest. So coupon is basically annual dollar coupon expressed as a percentage of face value. So basically coupon rate is expressed as a percentage of face value. So when you compute payments, you're going to multiply coupon rate with the face value to get the payments. And maturity is the term of the loan. Okay, so basically you have face value, coupon payments, and the maturity. Alright, so let's move forward. What are the different terminology we're gonna use in this chapter? I have just summarized here. So bond, as I explained earlier, bond is a debt instrument. So it's a security that obligates issuer to make specified payments to the bondholder. Okay, and the typical issuers are companies and governments. Maturity date is the promised time to repay the bond, and maturity is number of years between now and the maturity date. And a bond's maturity declines over time. Face value, also called par value or principal, also you can call future value, is the promise payment for the bond on the maturity date. And coupon is basically annual interest payment made to the bondholders, and usually stated as percentage of the face value. And coupons could be paid in annually or could be paid semi-annually. So most commons in bonds are semi-annual coupon payments. Yield to maturity is the total rate of return on a bond if you hold the bond until it matures. So in other words, yield to maturity is the rate of return you can earn in a bond if you hold until it matures. So it's same as a discount rate you use in time value of money chapter. So basically, when you compute coupon, in other words, when you compute payments, you're gonna compute payments as coupon rate times face value, and this is the timeline, so in this timeline the C stands for coupon, also you can call payments, and then F stands for face value. So at the end of the maturity, you're gonna get your last coupon payments plus your face value. Okay, so another term here we're gonna talk about is yield to call. So you know that yield to maturity is total rate of return if you hold the bond until it matures. So what is the yield to call? In some bonds, the bonds can be called in certain years, in pre-specified dates. So basically, if a bond is called, so the yield to call is the rate of return you're gonna make in a bond if it is called in a future date. So if a bond is going to be called in 4 years, so you're going to use that call price as a face value and compute your rate of return. So that's the yield to call. So the difference between yield to call and yield to maturity is the rate of return you're going to earn in the bond if you hold the bond until its maturity. So yield to call is the rate of return of a bond until the bond was called. So current yield, basically current yield is annual coupon payment divided by the bond price. So that's the current yield. In some bonds they do not pay any interest, and at the end of the maturity they're gonna pay everything. So they pay interest and principal together. So basically there are no periodic interest payments. So the entire yield to maturity comes from the difference between the price you paid and the face value. They cannot be sold for more than the par value, and they are sometimes called zeros, and they are in deep discounts bond, and then the original issue discount bonds. Okay, so the treasury bills and principal only treasury trips are the good example of zeros. Alright, so what are main provisions in the bond? Bond has different features. So what are these provisions in the bond? So some bonds have call provisions. So call provision gives the issuer right to call the bond in future. Sinking fund provision is this provision facilitates an orderly retirement of a bond. Okay, and convertible bond gives an option to convert bonds into fixed number of shares of common stock at the holder's option. Putable bond allows holder to sell bond back to the company prior to the maturity, and warrants provide holders option to buy stocks at a fixed price. Income bonds, basically they require to pay interest only if the company, the issuer, earns high enough earning to cover the interest expense. And index bonds are tied with the inflation. Okay, so the interest payments and maturity payments are increased automatically if the inflation rate increases. And the example of index bond is TIPS, Treasury Inflation Protected Securities, and US government issued first time in 1997. Okay, now let's talk about the bond market. And basically primarily it is the over-the-counter market, and the dealers connected electronically, and it's extremely large number of bond issues, but generally low daily volume in single issues. Most bonds are owned by and traded among large financial institutions, and Wall Street Journal reports key development in the treasury, corporate and municipal markets, and online edition lists trading each day for the most actively traded investment grade, high yield and convertible bonds, and makes it is very difficult to get up-to-date price for particularly bond for small companies or municipal issues, and one of the exception is treasury securities. So the bond market is really huge market. So let's watch this small video clip which summarizes the bond market. Okay, so let's watch this video clip.
Investing in bonds is basically investing in debt, and the value of the debt varies according to interest rates and the credit worthiness of the borrowers. Bonds have a wide variety of applications, from financing a resort hotel with corporate bonds, to investing a corporation's pension funds and treasury notes, to financing a department store's Christmas merchandise with commercial paper. They may not be exciting, but bonds play a major role in financing our economy. Their versatility and tax advantages make bonds a favorite tool for the largest borrowers in the world.
So now let's talk about the bond valuation. Okay, so value of any security is the present value of all future cash flows. Okay, so bonds of similar risk and maturity will be priced to the yield about the same return. Okay, so bond with similar risk and similar maturity will have similar return regardless of coupon rate. So if you know the price of the bond, you can estimate your yield to maturity. Okay, so we use time value of money concept to compute the bond value. Okay, so basically the value of the bond, value of a bond is the present value of annuity with lump sum. Okay, so a bond is gonna pay coupons in each time period, and at the end of the maturity the bondholder will receive face value. Okay, so here this C stands for coupon. In other words, this C is the payments each time period. So you discount coupon payment by the yield to maturity, which is the discount rate for each time period, including the last. So at the end of the maturity, you're going to receive your coupon and the face value. So these are all your cash flows. If you find the present value of all these future cash flows and add them together, that's going to be your present value, which is the value of the bond. You can use this formula, and we can use a financial calculator. We can use Excel. Okay, so it's basically a really good application of time value of money concept. Okay, so the value of the bond is the present value of all future coupon payments and the par value. As you can see from this equation here, R is the discount rate, which is called yield to maturity in the bond. So if the discount rate goes up, the present value goes down. Therefore, there is an inverse relationship between interest rates and the bond price. Okay, so bond prices and the market interest rate move in the opposite direction. So if the price goes up, that means the discount rate is going down. Okay, so let's use some examples. So before we start doing value computation, I just want to tell you, very important thing here. The coupon rate is not the discount rate. So be very careful. Coupon rate, you use coupon rate to compute your payments. So please do not get confused with coupon rate and discount rate. Okay, so I'm going to talk about it later on when I work a problem. Alright, this is an example of a bond which has a face value of $1,000, pays annual coupon payment, and has 5 years to maturity. Okay, so first thing you need to know is the compounding. So in this case, annual coupon payments. So basically, as you can see, this is the timeline for this bond. So time 0, here is nothing. So once you buy a bond, you're gonna receive your coupon payment at the end of the first year. So the coupon payment $80 is $1,000 times coupon rate. Okay, so these all are your coupons. So year 1, year 2, year 3, year 4. So these are your coupon payments. And at the end of the maturity, you're gonna receive your face value $1,000 and your last coupon payments. Okay. How about if you have semi-annual coupon payment? If you have semi-annual coupon payment, you're gonna receive your first cash flow, which is first coupon payment, in 6 months. So your second cash flow, second coupon payment is at the end of the first year. Okay, so this is how you're gonna draw a timeline with bond. Okay, so to compute the bond price, you must understand how you compute the payments, how you compute the coupon payments. Coupon payment is basically is the payment. Okay, you can use in your key in your financial calculator. So let's work on this problem. Suppose you have 8% annual coupon payments on this bond and has $1,000 face value, and it's going to mature in 4 years. So if the yield to maturity is 6.8%, what is the price of the bond? You can use this formula, and I'm not gonna go over too much about this formula. It's gonna be time consuming, but feel free to use your formula if you feel comfortable. I'm gonna show you how to use financial calculator to compute a bond value. So basically in this chapter you're gonna be using these 5 keys. Okay, if you are asked to find the yield to maturity, you're gonna use I by Y. If you need to find out the present value and the price of the bond, you're going to be using present value key. So basically you are using these 5 keys. It's a really good example of the use of time value of money in finance. Okay, so in this case, since your yield to mature, your coupon rate is annual compounding, so your N is going to be 4, your coupon rate, and make sure you understand that this your yield to maturity, your discount rate is your yield to maturity. In other words, this is the rate of return you are required to have to invest in this bond, 6.8%. That's your total rate of return. Okay, and your payment here, which is $80, is computed as face value times coupon rate. Okay, $1,000 times 8% is $80, and your future value is face value. you compute present value, you're gonna get your bond price. Okay, so let me show you the financial calculator here. So let's plug these numbers here. So you have 4, n equals to 4, 6.8. This is your coupon payments. I'm sorry, this is your discount rate, which is yield to maturity, and then your payment is $1,000 times 8% divided by compounding. In this case, is compounding is 1, so it's 80, right? So let's put this 80 in payments, and at the end of the maturity, you're gonna get the face value, $1,000. So compute or present value, that's the bond price. As you know that when you compute present value in financial calculator in Excel, you're going to have this negative sign. Does not mean that your bond value is negative 1040.83. Okay, so this is just cash outflow convention the calculator follows. That's why it has the negative sign, but the price of the bond is not negative. Okay, so now the same example. And what do you think this bond is? Is this the bond? Maybe you already know. Some bonds are discount bonds, some bonds are premium bond, and some bonds are sold at par. So what type of bond is this, do you think? Since the price is more than the face value, this is a premium bond. Okay, and I'm gonna go over that later on. Let's do another example. If the discount rate is, if the yield to maturity is 8%, what is the value of the bond? Okay, so look at this one. Your total rate of return is 8%, and you are already receiving 8% as a coupon payment. Therefore, in this case, even you don't need to compute anything. The price of the bond must be $1,000 because your yield to maturity is 8%, and you are already receiving 8% as coupon payment. Therefore, you don't have any capital appreciation, any capital gain yield. Okay, so but just for make sure, to make sure, I'll compute the value of the bond using 8% yield to maturity. So since I already have all this number here, all I need to do is I need to change my I by Y to 8%. So let me change to 8% here and compute my present value. So as you can see that the value of the bond is $1,000, which is same as the face value. Okay, so if you have yield to maturity and coupon rate are same, your bond price is going to be same as face value, so you don't have to compute that. You will be knowing that automatically. All right, so let's use 10% yield to maturity. Let's put 10% in I by Y. Maybe you are wondering why I'm just putting this I by Y, because I already have those numbers here. So I already have that N, I already have this payment, so I have all the information there. So I'm just changing my I by Y. So let's compute present value. I put I by Y is 10%. Now the price is $936.60. Okay, so why is it 936? The reason for that is because your total rate of return is 10%. Total required rate of return yield to maturity is 10%, and you are receiving 8% as coupon payment. Okay, so you need to make that extra 2%, which is coming in this case from the price appreciation, capital gain yield. Okay, so this is the example of discount bond, but I'm going to talk about these different types of bond later on. Okay, so let's go forward and let's talk about this another type of bond. It's a semi-annual coupon bond. So if you have semi-annual coupon payments, so only difference here is you're gonna divide your your coupon payment by compounding. So $1,000 is your face value, and your coupon payment is 6.375. Okay, and since it's a semi-annual compounding, you're gonna divide by 2 because it's your rate of coupon rate per period. Okay, so you divide by 2, that's gonna give your coupon payment of this one. Okay, so these are your coupon payments, and here at the end of the maturity you're gonna receive your face value plus coupon payments. So your last cash flow is gonna be your face value and coupon. Okay, so how to solve this one? As I mentioned earlier, we are using these 5 keys to solve this bond valuation problem. Okay, so you need to define your n. N is 5 years, and your compounding is 2, so 5 times 2, which is 10, and your interest rate, in this case your yield to maturity is 5%. Okay, so your yield to maturity, so your rate of return per period, which is every 6 months, so 5 divided by 2 is 2.5%, and your payment is your face value times coupon rate divided by compounding, which is semi-annual compounding, equals to 2. So if you do this operation, you're gonna get $31.88 here. Okay, so let's put this number here in the calculator. If you put these numbers in the calculator, you're gonna get $1,060.17, which is your bond price. Okay, now let's use the Excel spreadsheet to compute bond value. Alright, same problem. We have 5 years, we have yield to maturity is 5%, and then the coupon rate is 6.375%, and the compounding is semi-annually. Okay, so all you need to do is, you define these 5 keys. You can use the both same definition for your calculator and your Excel. Okay, so in Excel, so as you know that bond price is same as present value, so let's use the present value function. Okay, so when you start with equal present value, and now you need to define the rate. So the rate is rate per period. Okay, so let's find this rate per period. Actually I have already defined that rate per period, so let's before we even do this operation, let's fix this one. So your n is gonna be year times compounding, so which is called number of period. Your rate is gonna be 5% divided by 2, so let's put in the percentage. Alright, and then your coupon payment is face value times your coupon rate divided by compounding. Okay, so we use the same definition here, and your face value is future value is just the face value from the straight from the bond. Okay, so what is the bond price? That's the question. Let's start with present value, which is PV, and your rate per period, your number of periods, your payments, your future value, and you need to define when do you get the payments, end of the time period or the beginning of the time period. So since you're going to receive the bond coupon payment at the end of each time period, so let's put 0, close it, enter. So this is your bond price. Okay, so how do you compute your yield to maturity or duration on this bond? let's do an example. I want to know, so suppose you are given your, so if you are given just n payments and face value and present value, how do you find your yield to maturity? So what you can do here is you can use the rate function, rate, and start with the parentheses and number of periods, and your payments, present value, future value, and your, because since it's the end of the period, so we're going to put 0, close the parentheses, and you got 3%, which is rate per period. As you can see, it's similar to this one, right? So to get your yield to maturity, you have to multiply by 2, because rates are always annualized, which equals to this times 2 equals to 5%, right? So look at this one. So this one and this 5% same. So actually you can use this Excel spreadsheet to compute any bond problem. It's very straightforward. Okay, you just need present value, PV, number of period function in the Excel spreadsheet. Okay, so let's go back to our presentation here. So all right, now let's talk about bond yield. What is the bond yield? So bond yield is basically the rate of return you're gonna make in this bond. Okay, so let's think about this equation. So bond price is present value of all future cash flows, and now this R is your yield to maturity. So basically in your financial calculator, you're gonna be putting all the information and solve for I by Y. That's gonna give you yield to maturity. So yield to maturity is the discount rate on the bond, or is the total rate of return if you hold the bond until it matures. Okay, so let's watch this small video clip which explains yield to maturity very clearly.
If you hold a bond to maturity, are you guaranteed a certain rate of return? To answer that question, let me start by reminding everybody what we mean by the term yield to maturity. The yield to maturity is the rate you get when you compare the price of the bond to all of the expected cash flows throughout the remaining life of the bond. So if we compare the price to the coupons and the face value at the end of the bond, the yield to maturity is the discount rate which makes it all hold. Now, if you hold a bond till maturity and you receive all the cash flows that are promised to you, and if all the cash flows you received are reinvested at the yield to maturity, then it's true you will receive a guaranteed rate of return, which is the yield to maturity. Now, in practice, there's a couple issues that arise which keep investors from getting the returns they expect when they buy a bond. One issue is default risk. If you buy a bond and it turns out that the company goes out of business, goes bankrupt, then you're going to receive less than was originally promised to you. Okay? So even though you had a yield to maturity, let's say of 7 or 8%, you may end up with something that's a lot less. The other issue that comes into place is changing interest rates. If interest rates change over the life of the bond that you're holding, then when it comes time to reinvest the coupons, you may receive more or less than you originally expected. So again, in those instances, you may have more or less than the original yield to maturity. Finally, it's important to take into account the effects of inflation. If you buy a bond, hold it to maturity, and receive an 8% rate of return, what you ultimately care about is what you receive after taking into account inflation. If inflation turns out to be much higher than you originally expected, your real return is going to be considerably lower. Likewise, if you get an unexpected drop in inflation, then you may end up with a return that's much higher than you originally expected. That inflation risk is one reason why some investors have moved towards Treasury index bonds, which try to guarantee you a certain rate of interest after taking into account the effects of inflation. If you buy those bonds, you've limited inflation risk. You've also taken into account default risk because you're buying Treasury securities. However, you're still left with uncertainty regarding changes in real rates. So again, at the end of the day, nothing's completely riskless.
All right, so yield to maturity is the rate of return you're gonna earn in this bond, if you hold this bond until it matures. But there are several things you should consider. Yield to maturity is not guaranteed rate of return. Okay, so how to compute yield to maturity? So let's consider a bond which pays 10% annual coupon rate, matures in 15 years, and the par value of the bond is $1,000 and current price is $928.09. So what is the yield to maturity in this bond? So if you put, since this is annual coupon, so you have n equals to 15, your present value is the bond price, so put as present value. Your payments is 10% coupon times $1,000 is $100. Your face value is $1,000. Compute I by Y. So basically compute I by Y here, and you're gonna receive 11%. So let's try in our financial calculator. So 15, and we have $928.00 here, and let's put negative sign here in front of this number. And your payments is $1,000 times 10%, okay, equals to $100, and your face value is $1,000. You compute I by Y is 11%. Okay, so if the coupon rate is semi-annual, if the coupon is semi-annual compounding, so how do you compute your yield to maturity? Suppose the coupon payment is 10% and it's going to be semi-annual. Still the face value is $1,000 and the yield to maturity is 20 years, and if the bond is selling for $1,179.93, and what is the yield to maturity on this bond? Okay, so since this case we have semi-annual compounding, so your n is going to be t times m, which is 40, and your present value is going to be your bond price, and your payment here is $1,000 times coupon rate, which is 10%. Since it's semi-annual, you divide by 2, or you can get semi-annual coupon rate by dividing your coupon rate by 2. So 10 divided by 2 is 5%. 5% times $1,000 is $50, and your face value is $1,000. You compute I by Y. Okay, so compute your I by Y. You're gonna receive 4%, and since this is the rate per period, right? So as you know that this is the rate per period, so what you're gonna do here is you're gonna divide with the compounding, because you know that the rate of returns are always annualized, so they have to be annual rate. So this 4% is rate per period, which is rate every 6 months. So to get your annual rate, you have to multiply by 2, which is 8%. And if you use your Excel, again you're going to be using rate, and then you're going to define those inputs for this calculation, so which is pretty straightforward, similar to using financial calculator. Okay, now next thing we're going to be talking about in this yield topic is yield to call. Yield to call is basically it's the rate of return on that bond if it is called in a future date. Okay, so the only difference here is you're going to be using call price as a face value, because yield to maturity, this R is the rate of return on your bond if you hold the bond until it matures. But if it's a 10-year bond is called in 4 years, so you don't get that $1,000 face value, because your face value in this case is going to be the call price. Okay, so you have to understand how this gonna be, this information we can use in computing your yield to call. So if you use equation and solve for this R with this call price here and these coupon payments, you're gonna get your face your yield to call. Okay, so let's look this example. What is the yield to call of a 6% semi-annual coupon bond with a $1,000 face value and has 10 years maturity, and the market price of the bond is $1,010.77, and it can be called in 5 years at $970. So this is the key information. Don't get confused with the face value. The face value is the one you're gonna receive only if you hold the bond until it matures. So we are talking about yield to call. So the call price in this case is $970. So this face value is gonna be 970. Everything is gonna be same. So let's solve this problem using the financial calculator. Okay. So this is semi-annual bond with 10 years. So this is semi-annual coupon bond with 6% coupon, right? And it has 10 years to maturity. So let's guess here. So our N is gonna be 10 times 2, which is 20, and our bond price is $1,010, and our coupon payment is because we have semi-annual, so that means 6 divided by 2 times face value, which is $30, or you can do face value times coupon, which is $60, and you divide by 2 is going to be $30, and your face value in this case, your call price is gonna be $970. Okay, so let's do this computation using the financial calculator. So still you're gonna be using I by Y. Okay, so still this is I by Y. So your rate of return if this bond is called in 5 years. Okay, so let's start with our N, which is 10 times 2 is 20, and our present value is 10. Let's put negative, and payment is $30, and again is 6% times $1,000 divided by 2, which is $30, and your face value is $970 face value, and you compute I by Y, which gives you 2.82. So let me make this correction here. I don't know why it happened. So it's 2.82 and you times, because since this is rate per period, so rate per every 6 months, so you have to multiply by 2. So 2.82 times 2 equals to 5.64%. Okay, so 5.64%. That's the yield to call. So as you know that there is no difference between computing yield to maturity and yield to call. Only thing you're gonna have the difference is your face value. So face value is the future value. In other words, is the value you're gonna receive if you hold the bond until it matures. In this case, since the bond is gonna be called in 5 years, so you have to use this call price to compute your yield to call. All right, so let's go forward here and let's talk about the total rate of return on a bond. So total rate of return on a bond is called yield to maturity. It's a discount rate on the bond. So YTM, yield to maturity, equals to your yield to so current yield plus your capital gain yield. Okay, so current yield equals to your annual coupon payments, which is coupon rate times face value, and divided by current price. Okay, so that's going to give you your current yield, and your capital gain yield equals to, so change in price. Okay, so basically change in price divided by beginning price, that's going to give you your capital gain yield, which is your face value minus present value divided by present value. That's going to be your capital gain yield. So your total rate of return should be equal to these two returns. So current yield plus capital gain yield. Okay. Now let's look this example. So suppose a bond has, it's a 10 years maturity bond, pays 9% annual coupon and currently selling for $887, and this bond has face value of $1,000. So what is the current yield? Current yield equals to annual coupon. So annual coupon is 9% times $1,000, which is $90, divided by current price of the bond, which is $887. So you get 10.15%. That's current yield. Okay. Now in this example here, you don't have this yield to maturity. Okay, so let's look this yield to maturity here. Oh, it's coming to, so let's look this yield to maturity. So we have, this is 10 years bond, annual coupon. So let's bring our financial calculator here. Okay, so we have 10 years, n equals 10. We have present value is 887, negative payment is 90% times $1,000 is $90, and your face value is $1,000. Compute R by Y, which is 10.91%. So 10.91% is our total yield on this bond. So total rate of return is 10.91%. So to find your capital gain yield, what you can do is you can take out your current yield from the total yield, yield to maturity. That's gonna give you capital gain yield. So since this one current yield is 10.15%, our capital total yield to maturity is 10.91%. the difference is capital gain yield. So you should receive 0.76% in price appreciation. Okay, so this is here. I'm just doing same thing again. You can do compute this same thing in different ways. So what you can do is your current yield is definitely your total coupon payment. So your coupon payment, annual coupon payment divided by price, which is 8.35%, and then if you assume that there is no change in yield to maturity, then you can find the end of the year price. So basically the prior in 1 year, the price in 1 year from now is 11.93.68. So your current capital gain yield is the price difference. Okay, the change in price. So current price is 1197.93, and then your end of the year price is 1193.68 divided by the current price, which is negative 8.35%. So total yield equals to your current yield plus capital gain yield. So when you do that, you have 8.35 plus negative 0.35 equals to 8%. Okay, so this is how you can compute capital gain yield differently. Alright, so now let's talk about the relationship between bond price and the yield to maturity. Okay, in other words, discount rate. So as you can see in this horizontal axis, x-axis, we have these discount rates. In other words, yield to maturity. In this y-axis, we have here bond price. Okay, so let's look this one. If the discount rate is 0, the bond price is right here. Okay, and this one I don't have the coupon information, but I'm just showing you the discount rate, the relationship between the bond price and the discount rate. So that is, as the discount rate goes up, the bond price should go down. Okay, so the relationship between bond price and yield to maturity is inverse. So they are inversely related. So if the bond price, rate of return goes up, yield to maturity goes up, the bond price should go down. Okay, and we'll talk about this premium and discount bond shortly. Alright, so now let's talk about the premium bond and discount bond. So basically the definition of discount bond is the bond which has the price less than the par value. So if the bond price is less than $1,000, it's going to be called discount bond. So as I mentioned earlier, most of the bonds so we are doing in this example are like $1,000 face value. So if the bond price is less than $1,000, or in other words, if the bond price is less than the par value or face value, that bond is going to be discount bond. If the price is same as face value, then this is the bond sold at par. Okay, if the bond price is higher than the face value, we call the premium bond. So what is the condition to be discount or premium bond? So basically is that you're going to compare your coupon rate and discount rate, or in other words your coupon rate and yield to maturity. So if the coupon rate is less than the discount rate, then you're going to have the price less than the par value. So this is called discount bond. Okay, so if the coupon rate equals to discount rate, then the price is going to be same as the par value. If your coupon rate is higher than the discount rate, okay, in other words yield to maturity, then the price is going to be higher than the par value, so which is called premium bond. And next slide I'll show you with the computation. I'll compute those values and show you exactly. So the dynamics here is the maturity date. On maturity date, so the bond value is going to be same as par value. Okay, so on maturity date, if you buy a bond, you'll receive the face value and also you're going to receive the final coupon payment. Whether the bond is a discount or premium, okay, over time they converge to the face value. If there are two different bonds, so if there are two bonds, they are identical but have different maturity, the price of the longer term bond will change more than the shorter term bond if the interest rate changes in the market. Okay, so longer term bond is more sensitive to the change in the market interest rate. there are two bonds, they are identical but the coupon is different, the price of lower coupon bond will change more than the price of the higher coupon bond if the market interest rate changes. Okay, so now let's talk about the premium and discount bond in more detail. As you can see in this graph, this is y-axis we have bond price and x-axis we have yield to maturities. Okay, so if you have yield to maturity is 10 years, and if you have so here we have three bonds A, B, C, and we have 10 years maturity, 10% yield in each of these bonds, but the coupon payment is, the first one is 13% semi-annual, the second one is 10%, and then the third one is 7%. Okay, at the end of the maturity, at the end of the day, so when these bonds mature, the value of the bond is going to be same as the face value, so they converge to the face value at the end of the maturity. Okay, so in 10 years these bonds value is going to be $1,000, so they converge. So if premium bond comes back to $1,000, if discount bonds goes back to $1,000, so they converge to the face value. However, currently the price is going to be different. So let me tell you, your total rate of return is your yield to maturity. Okay, so in the case of bond A, your coupon rate is 13%, but your total rate of return is 10%. So as you can see here, 10% yield to maturity. So all these three bonds, if you buy any of these bonds, your total rate of return is 10%. However, this first bond, bond A, pays you 13% coupon, which means you are already receiving 3% more coupon payments. Okay, so if you go back to my earlier explanation here, let's look this one here, this slide here. Think about this yield to maturity. So your total rate of return is comprised of this coupon and your capital gain yield. So if you are already making more than your coupon is more than your yield to maturity, then definitely you're going to have this capital gain yield negative. Okay, so think about this equation when you talk about discount and premium bond. Okay, so let's go back to our slide here and talk about this one. So this is all about comparing your coupon rate and your yield to maturity. So in our bond A case, we have 13% we are already making, but your required rate of return is 10%. Therefore you're gonna pay more price for this bond, and then you're gonna receive $1,000 at the end of the maturity. The reason for that is because you are already making more than 10%, therefore you are paying more price for that bond. Okay, and the second bond, which is bond B, has coupon rate equals to yield to maturity, which is 10% equals to 10%. In this case, bond price is not going to be different. It's still, no matter how long is the yield to maturity, years to maturity, still the price is going to be same as the face value. Finally, okay, let me make this, maybe I need to make this change here, this discount bond. So this is the discount bond. Okay, so Alright, so this is the discount bond, and here this discount bond is this the red one. So you have 7% coupon, but your rate of return you need in this bond is 10%. So your total rate of return is 10%, but you are getting only 7% rate of return on your coupon. So you need to make that extra 3% from capital appreciation. Therefore you pay less than the face value. Okay, so it's all about your coupon rate and your yield to maturity. You compare them and find premium or discount bond. So to summarize, if the bond yield is less than coupon rate, in other words, if the coupon rate is less than a coupon rate is higher than the yield to maturity, is going to be called premium bond, and the bond price is going to be higher than the face value. If the coupon rate is same as yield to maturity, this is going to be bond sold at par. So there is no difference between the bond price and the face value. If the discount rate, if the coupon rate is less than, so we have here, if the coupon rate is less than the yield to maturity, okay, then this is called discount bond. So this one here is discount bond. Okay, and why do people buy a bond which is more expensive than the face value? So hope this explains you. So the rate of return, the total rate of return is 10%. If you are already making 13% in coupon payments, then you are happy to pay more than $1,000 for the bond, because your total rate of return is 10%. You are receiving more than 10% in coupon, so you pay more price for that 13% coupon. Okay, here same thing. If you are getting only 7% coupon, but your rate of return should be 10%, then you pay less price, and you earn that extra 3% from this capital gain. Okay, all right, so let's talk about risk in investing bond. So bonds with lower coupon are more sensitive to the changes in interest rates. So smaller coupon means more of the bond payments goes to the face value. So that means the lower coupon bonds has effectively longer maturity. So basically there are two types of risk in investing in bond. So the first one is interest rate risk. So the bond price move around the interest rate. Alright, so the uncertainty concerning the bonds price changes due to the change in interest rate. In other words, bond price fluctuates because of the change in interest rate is known as interest rate risk. And bonds with longer maturity and lower coupon have more interest rate risk. Okay, and another type of risk is reinvestment risk, which is the cash flow may be reinvested in lower rate of return. Okay, so it's uncertainty concerning rates at which your cash flow can be reinvested. So shorter term bonds have more reinvestment rate risk than longer term bonds, and high coupon rate bonds have more reinvestment rate risk than the lower coupon bond. Okay, so let's summarize this and let's look this graph here. So as you can see that this is a short-term bond. Here is 1 year bond. Okay, so as you can see, this one it has less interest rate risk, but this longer term bond has more interest rate risk. So you can see the more price fluctuation. Okay, so it's about mainly about the price fluctuation due to the changes in interest rate. Okay, so the longer term bond is more sensitive to the price fluctuation, to the change in interest rate. Okay, and to summarize, um, nothing is riskless, even if short term bond or long term bond. So if you have a short term bond, so you have interest rate in or price risk. So in the short term bond or a high coupon bond, you have low um, interest rate risk, and if you have a longer term bond and low coupon bond, you have high interest rate risk. Reinvestment risk: if you are a short term bond, you have high reinvestment risk, and if you have long term bond, you have low reinvestment risk. Okay, it's basically we are talking about the changes in price because of the interest rate changes. And then reinvestment basically means, suppose you have you won $1 million lottery, and then if you so you're gonna receive your interest payment, and then now if the interest rate goes down from 5 to 2%, then you're gonna receive only 2% interest on your interest. Therefore it has the high reinvestment risk. Okay, so next thing we're going to talk about is corporate versus government bond. So basically in the US case, we have treasury securities, and federal government issues those corporate bonds, and for shorter term we have treasury bills, and then for 5 to 10 years time period, US government issues treasury notes. So basically it's a maturity between 1 to 10 years is T notes, treasury notes, and if the maturity is more than 10 years, which is we call treasury bonds. So and also we have the government securities, which are bonds, also we call municipal securities. So these are the debt issued by state and local governments, and the varying degrees of default risk, and the interest received is tax exempt at federal level if you have municipal munis. So let's talk about after tax yield on your bond and compare with your tax-free bond. So if a taxable bond has yield 8% and municipal bond has 6%, how do you compare? How do you know which one is better? So what you're gonna do here is, if you have 40% tax bracket, which one do you prefer? So to make the comparable, to make to compare these two bonds, you have to find out the after tax return. Okay, so if your bond has 8% yield to maturity and you have 40% tax rate, so basically 40% of that 8% is gone. So 8% times 1 minus 4, which is, now you have only 60% left. So 60% times 8% is 4.8%. Okay, so 8% yield on your taxable bond is equal to 4.8% after tax yield. Okay, so now compare with your 6%, because municipal bond is tax exempt at federal level, so 6% is more than 4.8%. Therefore you would invest in that municipal bond even though it has only 6% return. Okay, so at what tax rate you would be indifferent between these two bonds? So basically your taxable bond times 1 minus tax rate equals to 6%. So if you solve for this t, you're gonna get 25%. Okay, so another thing we're gonna talk about, tax equivalent yield. So you can compare, this is one way you can compare these two types of bond and find out which one is better. In this case, you are converting your uh, taxable bond to after tax and comparing. Okay, and in this another example, if you use tax equivalent yield formula, which is tax-free bond, um, so rate of return on tax-free bond divided by 1 minus tax. So in this case we have 6% divided by 1 minus 40%, that gives you 10%. So you need to have 10% yield on this taxable bond to to have the comparable return, because this 6% tax exempt bond actually equals to 10% taxable bond. So you need to have more than, you need to have at least 10% yield on your taxable bond, so that you can be indifferent between these two types of investment. Okay, so basically corporate bonds are issued by um, the corporation. They are more default risk relative to government bonds, and the yield to maturity. So since they are more riskier, and the yield to maturity and corporate bonds uh, should be higher than treasury securities yield to maturity. Okay, so in other words, total rate of return on corporate bonds are higher than government bonds, since these are more riskier than government bonds. Okay, now let's briefly talk about inflation and interest rate, relationship between these two things. So inflation is basically the rate at which the prices, as a whole increasing, and nominal rate is the rate at which money grows. So in other words, it's a quoted rate, and a change in purchasing power, um, and inflation has effect on this nominal rate. So and the real rate is the rate at which purchasing power of an investment increases. Okay, so basically Fisher has two equation here to show the relationship between these two. So here is R is nominal rate, and this small r is real rate. So 1 plus nominal rate must be equal to 1 plus real rate times 1 plus h. Here this h is expected inflation. Okay, so if you want to find out your real rate, so what's going to happen here is you have to divide this 1 plus nominal rate by 1 plus h, and then take this one to the other side. So it's going to be 1 plus r divided by 1 plus h minus 1 equals to your real rate. Okay, so this is the exact Fisher's equation to find out real rate, but there is also an approximation formula. So according to the approximation formula, we have your nominal rate of return equals to your real rate of return plus inflation. Okay, so nominal rate of return includes inflation. Alright, so let's do a small example here. So and then see the difference between real versus nominal rates. So if your required rate of return is 10%, and if your expected inflation is 8%, what is the so the real rate is 10% and you have inflation is 8%. So what is the nominal rate? So if you use your Fisher equation, this is exact formula. So 1 plus r, so we're going to be solving for this big R, and equals to 1 plus real rate times 1 plus inflation. So if you solve for R, you're going to have 1 plus real rate times 1 plus inflation minus 1. So let's do this one. So you have 18.8% nominal rate. Okay, if you use your approximation formula, then you have real rate equals to 10 plus 8, which is real rate plus inflation rate equals to 18%. So because the real return and expected inflation are relatively high, so there is a significant difference between actual Fisher effect and approximation. Okay, so these are significantly different. Therefore, mostly, if you have smaller differences, smaller, real return and expected inflation, then these two different types of equation, different types of different methods yield the similar, very close results. But in this case, since we have very high expected real return and inflation, so we have the huge difference, which is 0.8%, which is a huge. Alright, let's talk about time structure of interest rate now. So what is time structure of interest rate? What is yield curve? So basically, the relationship between interest rates and bonds with different maturities are shown by the time structure of interest rate. So time structure of interest rate shows the relationship between interest rates and bond with different maturities. And yield curve is basically the graphical representation of the time structure. Okay, and yield curve, the normal yield curve is upward sloping, which means long-term yields are higher than short-term yields. If you have inverted, in other words, if you have downward sloping yield curve, then the longer term yields are lower than your short-term yields. Okay, so to just understand this a little bit in more detail, let's watch this small video clip.
What can we learn from the shape of the yield curve? The yield curve is a graphical depiction of the term structure of interest rates. It tells us the relationship between interest rates and maturity. An upward sloping yield curve indicates that long-term rates have higher yields than short-term rates. A downward sloping yield curve indicates the opposite, that long-term rates are lower. Now, the shape of the yield curve is determined by two key important factors. One is investors' expectations about future interest rates, and the other is different perceptions regarding risk. As far as expectations are concerned, if investors believe that rates are going to be rising in the future, that they're going to be higher than they are today, that tends to lead to an upward sloping yield curve. On the other hand, if investors believe that rates are going to decline, you tend to see a downward sloping yield curve. The yield curve is also affected by perceptions about risk. Generally, short-term investors perceive that there's more risk associated with holding their money in longer-term investments. They're nervous about tying up capital for long periods of time. And if that's the case, they need to get a premium or a higher yield to induce them to invest in longer-term securities. So any shifts in expectations or any shifts in attitudes towards risk are going to affect the shape of the yield curve. Now, the yield curve is used by policymakers, by investors, and by corporations to make important decisions. Policymakers, for example, the Federal Reserve, look at the shape of the yield curve to get important indications regarding investors' attitudes towards risk and in what direction investors think rates are going to be heading in the future. Investors look at the yield curve and look at this information to try to figure out what's the best place to put their money. Should they invest in long-term securities or short-term securities? What gives you the best bargain today? Finally, corporations look at the term structure of interest rates in the yield curve to give important indications regarding the type of debt they should be issuing. In today's market, are they better off issuing long-term debt or short-term debt? Again, information in that comes from the yield curve. So again, the term structure of interest rates tells us what is the relationship between interest rates and maturity, and that information is used by policymakers, investors, and corporations.
So now what is the time structure of interest rates and what is the yield curve and what does that different shape of yield curve means. So basically, let's go ahead and go to the next slide. So this one shows the yield curve. So as you know that if the yield curve is, so it's a normal yield curve which is upward sloping. Okay, so that means the long-term interest rate is higher than the short-term interest rate. So this is the example of downward sloping interest yield curve, which shows you this one here is the longer term yield is less than the short term yields. So this yield curves tells us a lot of things, so you know from this small video clip is very important in finance. So here is another example. Here it's yield curve for treasury security at different times. So as you can see the short term, so if you see the short term is, so here is short term and for different timing. So it's 1980, this one here on the top. So it's downward sloping. In 2000 we have this one is still a little bit downward sloping. In 2011 we have this upward sloping, which means the long term yield on this bond is higher. Okay, so I'm not going to explain too much about this yield curve, since you already know from in the the previous small video clip. Now we are coming to the end of this chapter, so let's talk about the determinants of bond yield. So basically the yield on the bond, which is called yield to maturity, or you can call required rate of return on a bond security, equals to these several factors. Okay, so the first one is risk-free interest rate. Okay, and then inflation premium, and you have a default risk premium, you have liquidity premium, and you have maturity risk premium. Okay, so whenever you have all these things going up, then your yield to maturity must go up. So these are the important determinants. So if you need more explanation, please read the textbook. It has a really good explanation on these different determinants of bond yield. So here I have just done an example. So suppose you have 3% risk-free rate, 5%, and then inflation premium for 5-year bond is 1.5%. Liquidity premium is 0.5%, and the maturity risk premium for this bond is given as 1 t minus 1 times 0.2%. So which is where we have t equals to years to maturity, and the default risk premium equals to 1.75. So what is the yield on this bond? Okay, so basically we are solving for r, and we are putting all these numbers here in this equation. So we have your risk-free rate 3%, you have inflation premium, which is 1.5%, then we have default risk premium is 1.75, and finally we have, let's see what we have. Liquidity premium is 5%, 0.5%, and finally we have maturity risk premium, which is t equals to 5 minus 1 is 4 times 0.2 equals to 0.8%. So putting everything together is the yield on this bond is 7.55%. Okay, so finally we're going to talk about the effects of bond ratings on bond price and bond yield. Okay, so higher, it's just like your credit rating. So if you have good credit history, then when you go to buy a car, then you pay maybe 0% or maybe very small percentage on your loan, on your car loan, on your house loan. So similar things are there for corporation. The corporate bond ratings, there are different companies, they track, they rate the bonds of a corporation, and which is we know the Moody's and S&P and Fitch, and they have different notation on these bond ratings. So as you can see here, this is Moody's bond rating, and this is Fitch and S&P 500 bond ratings. And as you can see here is you know grade of the bond, and here is the risk of this bond. Okay, so basically this triple A and two A's, one A and triple B, these are the investment grade bonds. However, the bond with the highest rating is the highest quality bond. Okay, so which means the capacity to pay is extremely strong for the company which has triple A rating. Therefore their default risk is very low. So if you go to that equation we just talk about the determinants of the bond yield, you know you have very low default risk premium. Therefore your discount rate on a bond is going to be smaller. If you have the second double A ratings, still it's investment grade bond, and it's high quality, and then the capacity to pay is very strong. So, okay, so these are the second type of ratings, and the third one is A ratings. Still investment grade bond, and risk is here is still strong. Okay, so basically means the capacity to pay, the investor is strong, but is susceptible to the changes in the circumstances. So some this has a little bit more risk. All right, so as you see the rating goes down from the top to bottom here. So double AAA is the highest quality, and C in this Modi case, or D in Fitch and S&P, these are junk bond. They're almost in default or maybe already defaulted. So the required rate of return on the bond depends on this rating. So if the rating is low, then these bonds have very high default risk. Therefore the risk on this bond is very high. Therefore the required rate of return on this high risk bond is very high. Therefore the price of these bonds, going from top to bottom is going to go down, because your required rate of return on this C or D types of bond in junk bond is really high. Therefore the price for this bond is very small, price for this bond is very high. So basically it's because of your risk. All right, so finally so here is how the premiums are added to your risk-free rate. So if you have treasury security, short-term, long-term, if you have corporate and short-term and long-term, you still have the inflation premium. You're going to add all of those. Maturity risk premium basically goes to long-term treasury and long-term corporate bonds, and default risk premium is basically for corporate long-term and short-term, and the same thing for liquidity premium. Corporate long-term and short-term bonds have that liquidity premium, and in the case of treasury, it's backed by US government, so there is no default risk and liquidity premium. If you have a bond, treasury bond, you can sell anytime. But if you have a bond for a company, maybe it's a small company, probably it's very hard to find somebody who wants to buy the either long-term or short-term bond. So you're gonna put more on default risk premium and liquidity premium for those riskier assets, riskier bond. So finally, before we conclude this class, so let's talk about the microeconomic factors that influence the interest rate levels. So basically, maybe if you have heard, the Federal Reserve board meeting. So every time they have, board meeting, and the market waits for their decision. So basically, if there is any change in Federal Reserve policy, that's gonna affect on the interest rate. So if the interest rate goes up, then it's gonna be cost very costly for the corporation to raise capital. So what's gonna happen is, um, the interest rate goes up, then the cost of capital goes up. So you have to watch for this Federal Reserve policy, Federal Reserve, deficit or surplus, and international factors. For example, if a lot of uncertainty going on in European countries, then that also affects to the US market, and level of business activity. So if the business activities is going down, so you can think of what type of effects is going to have on interest rate levels. So with this, we finish this bond valuation chapter. And basically in this chapter, I know it's a long lecture recording, but we have a lot of material we cover in this chapter. But the bottom line here is basically finding the present value. So the present value here is the present value of all future cash flow. In the case of the bond, those cash flows are coupon payments and the face value at the end of the maturity. So I have you have seen, I was using financial calculator. So in this chapter, if you know the meaning of those five keys, you can identify those five keys, you can solve any bond valuation problems. So hopefully this lecture video recording is going to help you to understand this chapter in more detail. So if you still have any questions, please feel free to email me. Thank you.